From a overseas business point of view, the budget was seen as a business as usual budget, given the current challenges that the government faces and obviously the fiscal difficulties that there are. The increased spending in healthcare, which was, of course, to be expected given the current challenges, but also the much appreciated announcement of increased investment in infrastructure as well. All, of course, has already been mentioned, without any real increases in direct tax, meaning the government will, of course, have to find this money from either borrowing or the sale of assets. And in reality, it will probably be a mix of both. From a UKIBC perspective, we were delighted to see the increase in the FDI rates for insurance rising from 49% to 74%. And more importantly, the announcement that the Indian owned and controlled legislation will be updated to allow foreign ownership of insurance companies in India. Although we did note that the budget referenced that adequate safeguards would need to be put in place for those foreign insurance companies, and we await to see the detail of what this actually means. UKIBC for a number of years have been pushing for the opening up of this sector, and we believe that it will not only allow for the creation of new jobs and taxation, but will also have a positive direct impact on FDI into India, as well as innovation. Currently, insurance penetration levels in India are around 3.4%, well below the Asia average of 5% and far behind the likes of Japan with 11%. This means there is still a large amount of unmitigated risk in doing business in India for overseas companies. It was also good to hear the announcement of the further disinvestment by the government in this sector, as well as the confirmation of the IPO of LIC that will take place in 2022, reducing the public sector dominance in the insurance sector and allowing for further competition. One added and often unrecognised benefit of opening up this sector is, of course, the new capital that will flow from these insurance policies and pension funds as they establish in India. They will be looking to invest those premiums in often safer asset classes, such as government debt or corporate debt, as well as those infrastructure projects. Looking at the budget from a foreign direct investment point of view, it's worth pointing out that the UK is the second largest G20 investor in India, and therefore an important partner in India's race to become a $5 trillion economy. Unlike many new FDI entrants into India, companies such as AstraZeneca, JCB, Perkins Engines and Rolls-Royce have been making in India for decades already. As I recently pointed out in one of my UKIBC blogs, as India strives to attract new shiny FDI projects such as Apple and Tesla, which will offer a great photo opportunity and a big news headline, it must not forget those that have already heavily invested. Through my 15 years experience in investment business attraction, those businesses that are already in your region are a far greater source of new FDI projects than brand new entrants, as those businesses have already created the complex supply chains needed and established those export routes. India, of course, has put a lot of eggs in the Making India basket, and it's fair to say it hasn't been quite the rip-roaring success that Mr. Modi would have hoped. A number of underlying challenges, such as land and labour laws, mean the programme's incentives are often outweighed by the high level of bureaucracy and these challenges. Recent evidence coming out shows that India was only able to attract 20% of FDI projects that were exiting China in the recent issues, and that's compared to 70% that was being able to attract by Vietnam. India therefore needs to address some of these non-tariff barriers and structural issues, meaning companies are choosing other locations for their manufacturing hubs over India. UKIBC's Doing Business in India report still shows that legal and regulatory impediments are the biggest challenges UK businesses face in India. And although we have to commend India on its rise from 142nd position in the Ease of Doing Business ranking in 2014 to 63rd position in 2019, there is still a lot to do to hit Mr. Modi's aspiration of being in the top 25 ease of doing business countries in the world. The budget therefore offered a great chance to address some of these structural issues I mentioned, such as land, labour and liquidity. On the latter, it was good to see the announcement of the permanent framework for the purchase of investment-grade debt, both in stressed and non-stressed assets. The ability of India to create its own corporate debt market and for businesses to have another vehicle for raising funds will hopefully bring down the overall cost of raising finance in India. The announcement of the Development Infrastructure Institute was also welcomed by the international business community and will help to attract foreign investment via sovereign wealth and private finance into these infrastructure projects. And more importantly, it will help to build a pipeline of investment-ready projects that many foreign investors have cited as being one of the key barriers to investing in India. We work with a lot of investors who want to invest in India, but struggle to find the right project with the right level of detail to allow them to do the due diligence to their board to make those investments. The creation of the Asset Reconstruction Company will also help to recapitalise the banking system. The UK did something very similar to this after the financial crisis with the creation of ring-fenced bad banks, built to take non-performing assets and loans and dispose of them through alternative investment funds and other investments. And hopefully this will have the same success rate that did. On land and labour issues, we will have to wait until India has a little more fiscal headroom to be able to address some of these major challenges. From a global business point of view, it was good to see no increases in direct taxation, but there's still some huge disparities in this area. And of course, the tax terrorism that Mr. Modi's government inherited via retrospective tax issues. We and the whole international business community are awaiting India's decision on the international arbitration rulings that found in favour of both Cairn Energy and Vodafone on retrospective tax. Acceptance by the Indian government of the arbitration will enhance India's reputation as a leading investment destination with rule of law at its core. One area that we've been advocating for a while is on the current disparity on the tax rate, especially linked to the corporation tax rates, where foreign companies have to pay a rate of 43.6% compared to domestic businesses at just 25%. Globally, the general practice is to have tax parity across all kinds of companies within the same industry. Tax parity and acceptance of international arbitration would vastly improve India's FDI attractiveness to the global business community. Finally, the announcement of the 35% increase in infrastructure spend will also be warmly welcomed. The announcement of projects including the spending on railways, which was being mentioned, with the Western and Eastern dedicated freight corridors announced, as well as the public and private partnerships at ports and at airports, will help to build connectivity, making it easier for businesses to build efficient supply chain networks and reduce the overall costs of logistics in India, which is often cited again as one of those barriers while businesses decide to move or to locate their FDI elsewhere. To sum up, as mentioned, it was a good business as usual budget from the finance minister. But as with everything, we await to see the detail, and we wait to see how these policies will be implemented.